Thank you for tuning in to another episode of the Dealmaker Series. Today, I am joined by Justin Turner. He is principal at Baker Tilly. Justin, tell us a little bit about yourself and tell us about the firm.
Yeah, thanks, James. As you said, I'm a transaction advisory principal at Baker Tilly. I've been with the firm since 2008. I'm actually still in my first job out of college. Baker Tilly is the sixth largest public accounting firm in the U.S. We've got 29 folks in Dallas who do nothing but buy and sell side quality of earnings, due diligence. And we've got about 160 TAS professionals across our 15 offices in the U.S.
Awesome. Quite the footprint. And I didn't know you were number 6, so that's awesome. I'm sure you're going to have a lot of good insights for us.
Yeah.
So let's talk about the current state of deal flow. What are you seeing? Are you seeing growth or is it tightening a little bit?
First off, I think this is a good time to be having a conversation like this because it's not just fully going crazy like it was coming out of COVID. We're seeing a lot more market, factors that are coming into play, but deal flow has been active. I'd say buyers are being far more selective and disciplined than they were kind of during the peaks we saw coming out of COVID. We also have some of our, larger PE fund buyers that are going more downstream than we've seen over the past 10, 15 years, especially it's usually when the company fits well with one of their existing portfolio companies, or it's a space that they're very interested in getting into and maybe have some experience with of other exits. And then some of our larger PE funds are also partnering more with independent sponsors. It helps with deal flow, helps them find good deals. So they're kind of going fishing in different ponds than maybe they had been for the past few years or when the markets were high. I'd say, as it relates to middle market, the first 5 months of 2026 have been good for, the middle market North Texas area. As we move into summer, we typically see a dip in activity, and usually when school lets out, and then it starts ramping up right before school goes back, and as we get closer to Labor Day. I don't think people like closing deals on their summer vacation, but you'll get a lot more sell side prep of companies considering going to market, after Labor Day. And then current state of deals as well. I mean, quality assets are going to continue to trade well, especially businesses, in my opinion, with recurring revenue, strong margins. They've got a good diversified customer base, resilient cash flow, and really top-notch management teams. That's always kind of a table stakes thing that people want to get into, is they want a strong management team. It always, deal dynamics help, even if there's not a ton of companies going to market at a given time. We still have situations where private equity's got a lot of dry powder that they can deploy. By no means are they writing blank checks, but they're conducting diligence and digging deeper, wanting to really understand these companies because they need to put money to work and put it to work well. So deals probably aren't moving as quickly as they did 2 or 3 years ago. They're getting more scrutiny, which is good. It means they know what they're stepping into. And then lastly, I'd say something that's helping us right now is seller expectations they're kind of slowly starting to align with market realities. Coming out of COVID, a lot of businesses sold super high multiples. Market started to tighten. Buyers brought their offers down. Sellers still wanted to get paid what their neighbor got paid, 3 years ago. So thankfully, that gap is starting to tighten, which will help deals get done, help them get done at the right price.
Yeah, I've heard a good bit of that echoed by a few folks this year. Are you expecting that, maybe deals that didn't get done last year or the year before might carry into summer, or are you expecting there to be quite the lull?
That's usually what keeps us busy in the summer and the first January and first half of February of every year is stuff that just didn't close by year end or didn't close before Memorial Day. Now, at least year end has actually got like tax reasons and financial reporting reasons. Memorial Day is just, like I said, people don't like closing deals on the summer vacation with their family. But there is a number of sell sides that are sponsor owned or founder owned that they've been trying to get their stuff squared away to start. And that's really what we've run into in the post-COVID era. I feel like every company that was top-notch quality, really clean, they sold at the market peak. And there was a lot of companies that either weren't ready to sell or they had some hair on them that needed to be cleaned up. And so we're hopeful that some of that cleanup or some of that leveling out is occurring and will keep us busy through the summer. It's usually sell sides are what we work on the most time in the summer to kind of prepare to go to market. But it's anyone's guess. In the business I'm in, we rarely know what we're doing 45 days from now. So,
Yeah,
every day is a new journey.
there you go. So what about deal structures? What are you seeing more frequently now?
Structure is always going to be a way to bridge valuation gaps and to kind of manage risk from the buyer's perspective. We're seeing creativity more so deal structure than just, all cash up front that you get when it's super competitive out there. Earnouts are super common, especially when there's uncertainty around future growth or customer retention once the celebrity owner retires. Rollover equities always going to be important, particularly in a founder-owned business, because buyers want the sellers to remain economically aligned with them. They don't want to buy your company and then you go live on a beach somewhere and not be focused on the business. They want their investment to be the gasoline that kind of helps growth. And so structure is a good way to ensure that everyone's aligned post transaction. And then also this, is always important, but maybe more so whenever there's some uncertainties on a deal, that there's a lot more working capital protections and tighter purchase agreement definitions around working cap, debt and debt like stuff that maybe a lot of unsophisticated sellers wouldn't think about. They're just thinking about the EBITDA multiple. But that's one of those things that are become really important, in markets like today, just making sure that everyone understands, how it's structured around working cap and debt like.
Yeah. So let's talk a little bit about industries and sectors that are most active. What are you seeing there?
We've being in North Texas, we've always had the benefit, of a strong economy, population growth, business migration, infrastructure investments are all huge for deal flow here and for what we're seeing. Right now, I'd say construction, residential services are really big spaces, especially if you got anything, the word data center in your name, it's pretty popular. The expanded use of AI has, increased the need for data centers. That's 101 there, but, it could be construction of the building, supplying the racks, supplying and installing the HVAC components, the cooling components of the centers. We've seen a lot of activity around those spaces. And then one thing that AI hasn't learned how to do is, plumbing, pest control, HVAC at your house. So and that's a super fragmented space. It's a bunch of owner operators that have got, 50 employees and a bunch of clients that are local. But a lot of times those are recurring clients. It's almost like a technology play, recurring software. You've got people that need, pest control monthly or quarterly, plumbing services, HVAC. So, a lot of private equities from all over are trying to roll up that space because it's super fragmented and it's recurring revenue that makes it really easy to model. Another, manufacturing, especially if it's niche manufacturing or specialty manufacturing, something that's got a defensible position. Aerospace and defense related parts manufacturing. A lot of times I see those as kind of market trend and administration proof because the U.S. government's still spending on aerospace and defense, no matter who's in office. And then outside of that, any manufacturing that's got strong operational capabilities, a really strong entrenched customer base, and domestic product offerings. Buyers like businesses with pricing power and supply chain resilience. And so we're seeing a lot of activity there. Lastly, I'd say anything with professional services, recurring revenue, compliance driven revenues, attractive, something that may be scalable with strong client relationships and, opportunities to expand through other acquisitions. You may be a payroll tax expert and someone may be a property tax expert. You can put them together and, you start to diversify a little bit.
Yep. It's interesting you pointed out construction and aerospace.
Mhm.
You're maybe the second person who I've interviewed who brought those two up. So that's interesting. That's an interesting shift. I didn't hear any of that last year. So I think,
Yeah, as businesses continue to move here, they'll need office buildings
yeah,
build out, or data centers built. So construction in that may not. I assume, especially with data centers, that's a national play. But like in Texas, we've got a lot of available land that needs to be built out, and so construction's, that's where the bucket I'd put it in is when you're building out all that infrastructure. And there's a lot of businesses that specialize in super small parts of that and that can be, that are attracted to, professional buyers.
yep, yeah, for sure. So what about economic forces that are impacting deals right now? What are you seeing there?
So yeah, I always think uncertainty doesn't stop deals. It just kind of changes how buyers evaluate them. Interest rates are continuing to impact, leverage levels and buyer returns. And that's what kind of goes back to some of the structure changes in the deals or, when you're evaluating it. So interest rates, just the uncertainty there has impacted the way we're doing deals, maybe not necessarily the quantity, but it's causing buyers, they're spending more time because they're probably putting more of their own cash down instead of leverage, that they're going to really focus on validating the earnings quality, customer stability, margin stability, cash flow conversions. Like they want to take as many unknowns off the table before going through with a deal. And funny enough, those areas are the ones that usually cause, even in the best of markets, cause deals to go sideways. If you've got uncertain earnings or customer concentration, like that hurts deals. You need to explain those things and get everyone comfortable with it. Tariffs and supply chain constraints are other considerations that, are affecting deals a lot really. And it's more supply chain in the HVAC for data centers. Some of those have a year plus backlog for
Yeah.
critical parts needed in new data centers. And then, as I said earlier, working capital is super important, especially when you're not, debt is harder to come by. You want to know that your cash is coming in, what the cash conversion cycle is, and the buyers want to know what the balance sheet they're stepping into looks like.
Yeah.
So, and because, all that to say, buyers are more focused on operationally executing post close because they may not have the same runway they would have in a more free debt type environment like you were at times over the past 5 or 6 years.
Yeah, for sure. So let's look into the crystal ball here a little bit.
Mhm.
We're middle Q2. What do you see coming next for the M&A space over the next 12 to 18 months?
So, I think we still have a lot of aging owners that are getting close to retirement without a transition plan.
Yeah.
It's a dynamic we've had for years,
Yeah.
and their kids don't want to run mom and dad's business. They're too cool for that. They don't want to make widgets. I think they call it the silver tsunami.
Yeah.
So that should ensure that the market remains active because those businesses will still come to market and some of them will be of high quality. But, the buyers are still going to be disciplined for the remainder of the year and moving forward on those deals. It needs to be a good company, a good price, a quality company. But I think the quantity will be there just from if you only are looking at retiring owners, not even considering the middle aged owner that wants to go from good to great and may need some outside capital to do so. So I think businesses with strong fundamentals will continue to be attractive and they'll get a lot of interest. I think diligence, quality, and operational scrutiny will continue to be elevated. It's not going to jump back down to what it was coming out of COVID. And I think because of that, you'll see longer deal timelines, more rigorous QB analysis, and a greater emphasis on post close execution. As great as everything may be, the buyers are still going to really want to make sure they fully understand a business, understand why the seller's selling. Are they just getting out at the high? Are they really wanting to retire? Um, and all that stuff. And so I think that puts a lot of pressure on the diligence team to make sure that they uncover every rock, which I think we're pretty good at, but that the deal flow should still be there. At some point, certain sellers that have been sitting on the sidelines for a while are going to want to retire. And that just natural cycle is something that I've continually seen over my career. And that as long as those businesses still exist, we people wanting to buy them and they'll be going to market.
Yeah, for sure. For sure. Good, good intel there. Justin, I appreciate your time, your insights. For those watching, you can find more insights and episodes from the Dealmaker series by following my YouTube channel or connecting on LinkedIn, Justin Turner. Thank you, sir.
Thanks, James.